Welcome to CoreLogic's housing market update for February 2025. Nationally, dwelling values were steady in January, continuing a softer trend of housing conditions that's been evident through most of last year and now into 2025. The annual growth trend has more than halved since moving through a cyclical peak in February last year, slowing to just 4.3% in January. Drilling down, the national headline result was weighed down by the capital cities, where values fell by 0.2%. The combined regional markets were stronger, with values rising to new record highs, with a 0.4% lift in values over the month. Across the capitals, 3 of the 8 cities recorded a decline over the month, led by Melbourne with a 0.6% fall, followed by the ACT and Sydney. The mid-sized capitals are still seeing growth, but conditions have eased here as well. Brisbane and Perth have recorded a clear and steady loss of momentum, especially in the detached housing sector, where value growth has eased more noticeably. Adelaide's shown a more resilient trend, although the pace of gains is slowing. Adelaide's led the growth tables over the past few months, taking over Perth's top position. Regional markets seem to be benefiting from a second wind of internal migration that's supporting demand. However, the trend is shifting from the heights of the pandemic, where commutable lifestyle markets were standing out with the highest rates of capital gain. The strongest regional markets are now centred in regional Queensland, with Townsville up 26%, Central Queensland up 20%, and the Mackay region up a little bit less than 20%, leading the annual growth tables. In other signs of a slowdown, the national volume of home sales also appears to have peaked. Annual sales moved through a cyclical high point at just under 535,000 sales in the year to October, and they've since eased back to 526,000 over the year to January. Rental growth bounced slightly higher in January, up 0.4% over the month, following a subdued second half of 2024, where the national rental index held virtually flat. Every capital city recorded a subtle rise in rents over the month. However, the trend is clearly pointing to an ongoing easing in rental price growth. On an annual basis, Australian rents were up 4.4%, which is still more than double the pre-COVID decade average of 2% annual growth. However, with rental growth slowing more visibly through the second half of last year, the annual change in rents is likely to fall below average levels in the first half of 2025. The 6-month trend in rental growth has turned negative across the 2 largest markets, Sydney and Melbourne, with rents down 0.4% and 0.6% respectively, with larger falls across the unit sector. The remaining state capitals have all recorded a clear slowdown in rental growth as net overseas migration and larger households help to ease rental demand. Regional rental conditions have been stronger relative to the capitals, with the combined regionals rental index up 1.6% over the past 3 months, compared with a 0.3% rise in rent across the capital cities. The pace of growth in Adelaide home values has been more resilient than most markets. Although the rate of growth is easing, with a 0.7% rise in values in January and up 1.8% over the past 3 months, Adelaide has overtaken Perth to record the highest rate of growth across the capital cities. Strong conditions are supported by ongoing low levels of supply, where listing numbers remain 4.3% lower than a year ago and 41% below the previous 5-year average. With such low stock levels, homes are continuing to sell rapidly, with a median of 29 days on market, lower than the 31-day median at the same time last year. With the prospects of a rate cut as early as February, the housing outlook is starting to look a little more positive, but we aren't expecting any material rise in home values until interest rates return closer to the pre-pandemic average and affordability improves further. The commencement of the interest rate easing cycle will be welcome news for borrowers and prospective buyers alike. Following a lower than expected core inflation outcome for the December quarter, there's still a good chance we'll see the first rate cut in February. Additionally, most forecasts are factoring in 3 to 4 25 basis point cuts from the RBA this year, implying that by the year's end, the cash rate would be between 3.35% and 3.6%, but that's still well above the pre-COVID decade average of 2.55%. Nonetheless, lower mortgage rates should act as a net positive for housing demand, increasing borrowing capacity and providing some repayment relief for borrowers. Along with lower cost of living pressures, a lift in sentiment and income growth, housing demand should see some support. Low levels of newly built housing supply should also deliver some support to housing values. The good news for housing supply is that dwelling approvals are once again trending higher, although this is mostly for houses and is more evident in Western Australia and South Australia, and to a lesser extent in Queensland and Victoria. However, high labour and material costs, as well as ongoing competition for key inputs with the public infrastructure sector, are likely to keep the flow of new housing supply at insufficient levels for some time yet. Some regions have seen a substantial affordability improvement since peaking back in 2022. Hobart's recorded the most significant correction, with dwelling values down 12.5% since moving through record highs in March 22. In dollar terms, this means the median value is now approximately $94,000 lower. The ACT has recorded the second largest decline amongst the capitals, down 7.1%, or roughly $65,000 down from peak levels. Melbourne values are 6.9% below peak levels, the equivalent to a drop of around $58,000 in the median value. Other markets are likely to struggle with affordability pressures even as interest rates drop. Over the past year, home values in Perth have surged by 17.1%, or $118,000, resulting in a 78.2% increase over the past 5 years. Adelaide has seen values rise by 12.7% in the last 12 months and 73.7% over 5 years. Brisbane's up 10.4% over the past year and a 70% rise in 5 years. Although Sydney's recorded a relatively mild 1.7% rise in values in the past 12 months, in dollar terms, that still equates to about a $20,000 increase. A rise in demand for housing from lower interest rates will be partially offset by slower population growth. After peaking in the first quarter of 2023, the net overseas migration rate is expected to reduce further as overseas arrivals continue to moderate, alongside a pickup in departures as the surge in temporary migrant visas expires. Less migration is likely to flow through to further easing in rental conditions and, over the medium term, reduced demand for home purchasing. Tighter credit policies could also be a wildcard, potentially slowing housing markets in 2025. APRA has stated the risk of financial shocks has not abated, and the RBA has warned previously that high household debt levels, especially housing debt, are a key vulnerability. Any material rise in household debt ratios could be a trigger for tighter credit policies, which would likely put a dampener on housing demand, similar to earlier periods of macroprudential policies. Overall, lower mortgage rates and a subsequent lift in borrowing capacity, as well as an undersupply of newly built housing, could be setting the foundations for a relatively shallow housing downturn. But the easing cycle for interest rates is likely to be a gradual one, and we also have the ongoing headwinds of affordability constraints, normalizing population growth, and generally soft economic conditions to contend with. All things considered, the likelihood of a significant growth cycle over the coming year remains low. If you'd like to stay up to date with all the ebbs and flows in the housing trends, make sure you're following the news and research pages at the CoreLogic website and tune into our regular updates at all the usual social media channels.